U.S. consumer confidence rose to an 8-month high in December. Amid signs of fading inflation, but the lowest share of households planning to buy big-ticket items over the next 6 months since June 2018 kept a lid on spending plans this month. Other data on Wednesday showed sales of previously owned homes falling for a 10th straight month in November, the longest such stretch since 1999. The economy is on recession watch as the Federal Reserve, which is in the midst of its fastest interest rate hiking cycle since the 1980s, wages war on inflation by trying to cool demand for everything from housing to labor. The recent rise in unemployment has caused consumers to be more cautious, although they have been more confident at times, particularly after a month of only slight growth. The steady increase in unemployment has forced consumers to be more careful with their spending, a senior economist at Wells Fargo in Charlotte, North Carolina. The outlook for consumer confidence in 2023 will hinge on the Fed's ability to deliver a soft landing on what could be described as a narrow runway. The improvement in confidence was driven by rising income expectations and more favorable views of both the current and future job markets. While it is not surprising that all measures improved, falling gasoline prices likely helped boost consumers' perceptions of the financial situation of their households, said Lynn Franco, director of economic indicators at the Conference Board. Consumer inflation expectations fell to their lowest level in almost 8 months, weighed down by a sharp drop in oil prices 6.7%, the lowest since September 2021, from 7.1% last month. The improvement, which mostly reflected lower gasoline prices, was in line with recent data showing consumer prices increasing moderately in November. It also strengthened views that inflation, though still uncomfortably high, peaked months ago. The Present Situation Index, based on consumers' assessment of current business and labor market conditions, rose to 147.2 from 138.3 last month. The Expectations Index, based on consumers' short-term outlook for income, business, and labor market conditions, increased to 82.4 from 76.7. The Conference Board's index of leading economic indicators rose for the 13th month in a row, but its level was still near 80, a level the Conference Board said is associated with recession. As a result, consumers were less keen on buying big ticket items over the next 6 months. The share of consumers planning to purchase a motor vehicle was little changed, while intentions to buy appliances were the lowest since July. That is also a function of higher borrowing costs, as most of these goods are bought on credit. The U.S. Central Bank has hiked its policy rate by 425 basis points this year from near zero to a 4.25% 4.50% range, the highest since late 2007. Last week, the Fed projected at least an additional 75 basis points of increases in borrowing costs by the end of 2023. Consumers, however, plan to go on vacation over the next 6 months, with the share rising to 46.2% from 45.5% in November. Most intended to vacation locally, which could help to keep a floor under consumer spending. The survey's so-called labor market differential, derived from data on respondents' views on whether jobs are plentiful or hard to get, increased to 35.8 from 31.5 in November. This measure correlates to the unemployment rate from the Labor Department, and the rise in December was consistent with tight labor market conditions. Stocks on Wall Street were trading higher. The dollar rose against a basket of currencies. U.S. Treasury yields fell for the hoarding workers, though there have been job losses in the technology sector and the interest over sensitive housing market. Employers have been generally reluctant to lay off workers after struggling to find labor during the COVID-19 pandemic. But with the housing market in the doldrums, economists believe the labor market will loosen and unemployment increase next year. Though the housing market accounts for a fraction of the Economy, it has a bigger footprint. Fewer consumers plan to buy a house over the next 6 months, which could keep home sales on the back foot. Existing home sales tumbled 7.7% to a seasonally adjusted annual rate of 4.09 million units last month. The National Association of Realtors said in a separate report on Wednesday. Outside the plunge during the first wave of the COVID-19 pandemic in the spring of 2020, this was the lowest level since November 2010. Sales dropped in all 4 regions and plummeted 35.4% on a year-on-year basis in November. Reports this week showed confidence among home builders dropping for a record 12 straight month in December, while single-family home building and permits tumbled to a 2.5-year low in November. The housing market boomed early in the pandemic as Americans sought bigger properties to accommodate home offices, driving up prices beyond the reach of many. Even with demand down, supply remains tight, keeping home prices elevated, though the pace of increases is slowing. The median existing house price increased 3.5% from a year earlier to $370,700 in November. It was still the highest house price for any November, and prices remain about 37% above their pre-pandemic level. The average rate on a 30-year fixed-rate mortgage surged to above 7% a few months ago, the highest since 2002, according to data from mortgage finance agency Freddie Mac. Though the rate has since retreated to 6.31% last week, it is double what it was that time a year ago. High rates make buying expensive for potential new homeowners, but they also tend to lock potential sellers in place given millions hold sub 4% and even sub 3% mortgages, said Robert Frick, corporate economist at Navy Federal Credit Union in Vienna, Virginia. We'll need a thaw in mortgage rates before existing home sales warm up in 2023. Right here. Please subscribe for the next video. Thank you for watching.